Welcome to another video in our series brought to you by the SBDC Toledo and the Toledo Regional Chamber of Commerce. Today, we're going to talk about one of the most important financial statements that you can pay attention to, compile, and that's the income statement. We've heard this called the profit and loss, P&L, income statement. It's called many different things. Here's the most important aspect. You should be doing this every month. And here's why. One of my favorite questions to ask, and I work with small business owners, is, hey, how's business? And normally it's business is great, business is good, oh, we're kind of slow. My second question, one of another favorites to ask is, how do you know? And I often get, well, we're not working as much, or we're not getting a lot of calls. That could be different. Now the income statement, the profit and loss statement, that's all a measure of how's business. So we're going to take a look at this very basic income statement today. I've structured it a little bit differently, just so we could talk about the aspects of it. Now, if you print this off or pull it off of QuickBooks or New Cash or some kind of accounting software, it's not going to be as pretty and straightforward, but the basics as to what I'm going to discuss here certainly apply. The theory is still the same. The benefits are still the same. If you need help reading it, that's a great time to get in touch with your small business development center, and they can help you, kind of sort out what does this look like and exactly, how well are you doing or not. So let's just jump in. Now, the income statement is for a period of time. So we really don't get a lot of value if we look at all of the profits and losses forever, like we do on the balance sheet. But the income statement is for a period of time. So in our example, we're going to talk about the month of January this year. We're going to use something called a cash basis. Now, that's a whole other conversation, but many small businesses do and frankly should use what's called a cash basis. Let me just give you a quick example of what that is. There's two different ways to look at this. If you're interested or want to do some research, there's the cash method and there's the accrual method. The accrual method is often used by larger companies. It can get a little confusing from time to time, but here's the best thing about cash. If you use the cash method to compile your income statements, you can do almost everything off of your bank account statement. It makes it really easy. When cash comes in, or obviously a check or an online payment or whatever, but when some form of cash comes in, that's revenue, that's a sale, right? When cash goes out, that's when you book the expenses. It's really easy because you don't have to track a bunch of what ifs or when do they pay or those types of things. So when we're talking about revenue here for this month of January, this fictitious business that I made up would have collected $25,251. So their bank account went up at some point. Maybe it went back down when they started spending, but $25,251 entered their bank account or their cash till during the month of January. Maybe they sent out $30,000 in invoices, or they made $50,000 in sales. When cash accounting, which most small businesses should use, none of that matters. The only thing that matters is that the cash came in. So when we talk about total revenue, that's really everything that's from the operations of your business. If you have, some of these idle advance or forgivable PPP loans, that is a form of revenue, but you don't want to put that as revenue because that's eventually going to be taxed if you put it in the wrong place on your reporting. So that doesn't really show business sales, right? It shows that money's coming in from grants. So this particular business has one line of revenue where it was just all the total revenue. We'll have another kind of video looking at an advanced income statement where we talk about different product lines and how those kind of contribute to your revenue. So revenue, cash in, looking at our bank account statements, those types of things, showing money coming in to our business. So that kind of wraps up half the income statement. That's great, right? There's your revenue, your sales, your income, all those mean the same thing. Now the expenses really tell sometimes a little more interesting story. So with the expenses, we can look to see different margins and in some cases different ratios to tell us if we're in line. So let's just kind of walk down through some of these. The cost of goods sold can also be a cost of sales. So if you're selling a product, if you're selling mowing equipment, or if you're selling any kind of whole good, those could be a cost of goods sold because you'll have what? You'll have an invoice amount, right? You know exactly what you paid for it. In this case, we're talking about a fictitious lawnmower shop where the cost of goods sold for that month were right around $8,200, and the estimated cost parts, and there's a reason it was estimated, but you would have invoices. The estimated cost parts would be $3,500. Again, you would want to do this from your bank account, and you would see what checks you wrote out or what payment you made to your suppliers. Now, it's outside of a small 10-minute video, but if you happen to use a credit card for things like this, those get booked in a different way. And again, it's not hard when somebody explains it or works through it with you one time, but the SBDC is a perfect place to call and kind of get some help walking through that. So one of the things that we have here is our gross profit. And that tells us that we brought in $25,251. We spent $13,500 on, parts and our whole goods. So that means, and this is kind of insightful, that means it tells us that we kept 54% of our money. That's not good or bad, really. You can't say one is better than the other because all of the industries have different standards, essentially. So, the gross profit of a grocery store, a can of corn, is going to be very, very small. Very, very small. The gross profit on a Ferrari is extremely high. So you can't say one gross profit is better or gross margin is better than the other. It's all industry specific. Here's one thing it does tell us, though. Gross profit and gross margin give a lot of indicators about your pricing and cost. So, let's say we're not selling whole goods, we're selling consulting services. Well, our cost of goods sold then would be cost of sales, and really the cost of sales would be what? Salaries for consultants. So we could look at industry standards and see if, hey, is our gross margin right? Are we paying our consultants too much, not enough? Are we pricing too high, pricing too low? Again, there's so much that just a regular QuickBooks generated or even sitting at the kitchen table looking at your bank statements, there's so much an income statement can tell you about your business. Everything else is really just where you take, what you spend money on each month and you list those all as expenses. Maybe you won't have one every month, but a lot of times there's a lot of monthly reoccurring charges that you have. So this part isn't too tough to figure out. You're welcome to use, what I have here as an example. If you use QuickBooks or NewCash again, it'll kind of make this for you. But it's just a list of all of your expenses and how much you spend. Now, again, each one of these doesn't tell us much. The information altogether with the gross margin calculations, your pre-tax profit calculations, all that really tells an important story. But what's also great is that once you start doing this each month, you can track your expenses going up and down and see if you're not making the amount of money that you wanted to make, where are you spending it? If you, took in $25,000 in both, we'll say January and February, but you made almost nothing in January and you were able to hang on to $12,000 in February, where did your savings occur? A lot of small business owners feel like they're working, and they don't have any money. Well, if you're not tracking this on an income statement, then you don't know where it went and you don't know how to correct the problem. It's just so important to measure these things and then use the information to make decisions. This particular company had a pretty rough January, right? We see that all the expenses ended up at about $11,400. And if we were to combine our $11,400 plus, which is all the other expenses, we'll call them, plus our $13,551, we can see there's not much left, right? So the $25,000 minus your minus your cost of goods sold gives us a gross profit of $13,500, minus the rest of our expenses of $11,000 gives us, almost nothing, and gives us a really low margin. We would want to know why. But we can't understand why until we have data such as the profit and loss statement. Again, not too hard to do. Most folks can either print it off of QuickBooks, sit at the kitchen table with their bank statements and maybe their credit card statements, put something like this together, do it each month, and you can see your sales growth and sales declines. But but you can also see where the money's going if you don't feel like there's enough in your pocket. Again, if you need help, please reach out to the SBDC, and hopefully this was informative. Thanks.